Day I'm hustling.
Welcome back to the Matrix. You're not just in the Matrix. You are the Matrix. How's it feel, Neo? And today, we got ourselves a banger daily market news analysis. What is up? How's everyone feeling out of 10? Let me know down in the comments below. We're gonna live react to Jerome Powell's reaction. Jay Peasy about to move the markets or what? Humble servant, thank you for the $1.99 donation, brother. I appreciate you.
But the cream will rise to the top. Oh yeah.
LFG ski. This time it LFG. After Morgan ski. What up, brother? Brandon, what's up, bro? Still holding longs, right? What is FOMC meeting? It is it's the Fed, Jay Peasy. To see, are they going to cut rates? Are they going to raise them? What is the deal? It looks like the decision's already been made. United States, if anyone has a decision, he's supposed to speak in like 30 minutes. So we'll play that when he speaks. Nothing yet. So it should be starting any minute here. So we'll watch that when it starts. Keep an eye on that, guys. Make sure there's nothing. And then we'll keep an eye on the markets. Rates held steady, but it depends if he's hawkish or dovish. No cut. All right, there we go. It's 4.2 to 4.5. He's speaking now. On what channel? We're so cooked. Where's he speaking at? No cut. No cut. No cut. No cut. Decision's already been made. Yep. Hawkish. Where is it at? What I'm looking at, it doesn't have it. Let me refresh this. What the hell, Yahoo Finance? What the hell, Yahoo Finance? What are we doing? This isn't it. CNBC. Is this it right here? Yeah, I don't think he started speaking yet. Maybe he has. Yeah, I don't think he started speaking yet. He talks at one. Yeah, you guys are pulling my leg, man. He said he started speaking. 20 more minutes. I want a refund. All right. Let me know when he starts speaking. We'll pull up Yahoo and we'll pull up CNBC. That way we're ready to go either way. Here's Bloomberg. I don't care about Bloomberg. Hold on one second. It's right here. All right, so we got both of them up, ready to go. This one is already... Let's get this one live. Bloomberg Television. What are we expecting them to say? I don't really care. You guys are just interested in this, to be honest. They'll all stream it on YouTube. What are we expecting them to say? No cuts. I want a refund. Still holding your longs, right? Yes. Do you think Uni will go under 10? Will Uni go under 10? Let's see. Do I think that Uniswap will go under $10? No. I do not. Thoughts of AIOZ and Render? I think Render gets to $30. Like the context that you need to look at Render with is it already did a 30x. You know what I'm saying? AIOZ though. $3. Let's look at Bitcoin dominance. Don't start. Don't start, TikTok. Don't start with me. 59.7. Getting pretty close. Getting pretty close. How hot are we? Pretty hot. We're getting hot for sure. What are we on the 3 hour? Pretty hot. I'd say we have a divergence on the 1 hour. Mario, thanks for the lightning, bro.
But the cream will rise to the top, oh yeah.
Ondo, Pepe 2 to 3x. Ondo, $3 to $4 to $5. Means going down more? What means that? Check the link. Nothing yet. Let's check Yahoo Finance. Nothing yet. It should be in 12 minutes. ICP bottomed out yet? I think so. Let's look at ICP. ICP and Rose for blue chips are the top, in my opinion, risk to reward value. Yes. That's a lot of support back here at $8. You're welcome. Thoughts on FOMC meeting today? My thoughts are, he's going to say stuff that's going to move the market. That's my thoughts. And by 3 days from now, the market, typically this is what you see. This is what happens every time. Let me tell you exactly what happens literally every time. It starts low and pumps. And then by 3 days later, it's back at the normal price. Or it starts high and then dumps. And then by 3 days later, it's back at the normal price. That's what's going to happen. So 3 days from now, we're going to be back at the same price. I know that that's boring. And it's like, all right, good stream. But that's the truth. I'm not engagement farming over here. That's why he's live. What's your top plays for Q1? ICP Rose. VeChain for blue chips. Micro caps. Solnik. Harmony One, or not Harmony One, News Media for medium caps, Harmony One, Flux, Dynex. Yeah, I'll be doing a Flux video after this. I'll be going over Flux, Crow, Quant, ICP. I'll be doing all 4 of those today. And then you guys can comment on what you guys want me to do for tomorrow. And we'll just keep doing that. We'll get back to the coin reviews, Hopium videos. All that good stuff. All right, let's take a look. Is that Flux Power? Sing me to sleep about Flux. Can you include Rose in that video? I don't remember if Rose got the criteria, but we'll probably be making Rose very soon. Could you look at MAGA coin? How long until the announcement? Like, probably like, what is it? 14 minutes. Dims will never recover. It says, look at MAGA. All right, let's check out MAGA. MAGA's cooked. I'm gonna just tell you. I'm gonna just keep it a buck with you, bro. What was the one? I think I had it on my Wyckoff list. Here we go. Yeah, this is not good. I had hope, but yep. Damn, that's crazy. Wow. Dude. What do I keep telling you guys? Sooner or later. That is insane. I have not looked at this chart in a minute. What have I kept telling you guys? Sooner or later, gaps get filled. No matter how bullish. The charts have a magical way of collecting the debt. A Lannister always collects its debt. The charts have a magical way of collecting its debt. There was a big old gap printed here on MAGA as it just ripped right past $1. And here we are. A Lannister collects its debt. A gap in the market collects its debt. So there you go. I didn't predict it like, oh my God, Trump's going to launch his own coin. And I didn't predict any of that. But we did have this put here. We had the gap. So there we go. I mean, honestly, it's probably going to reaccumulate now. Probably going to reaccumulate now. But like, damn, I don't know that it's going to go parabolic again with Trump having his own coin. You know what I mean? That's going to be a tough sell. Like you're an imposter at this point. I don't know, but even a retracement though is a 10x, so if it could get back to $10, it's not the Trump coin, but yes, it was like the original Trump coin. It was the original like political coin. But damn, like I've said it 300 times on this channel. Gaps, sooner or later, they get filled. That's why I don't like Turbo. It's like, we look at Turbo. Everyone's like, oh my God, Ski, why don't you like Turbo? This is why. You see gaps like that, it's not good. Sooner or later, one way or the other, they just have a way of working itself out. I don't know if it's the puppet master. I don't know if it's because we believe it's so, it's going to be so. I don't know if it's what the case is, but they have a way of working themselves out. And here we go. Here's Turbo. Massive gap. That's my thoughts. Sooner or later. And this is already cracked below the 200. Everything's sloping downside. This is a steep. I mean, this is getting pretty. I would anticipate a bounce. I don't think it's going to go straight there. It's definitely going to find support here. But sooner or later, that's what happens. Gaps get filled. Who gives a flux? How high can flux go? $5 to $20. So it's $5, $8, $20. $5, $12, $20. Those are my low, medium, high. Dot 10x. Brett, $10 billion market cap is my prediction. V-Chain, 40 cents. What can you explain what you mean by massive gap? Yes, I can. Okay, just an example for Turbo. This is an unfilled gap. And then let's pull up, like I haven't looked at the Trump coin in forever, as an example. And we see this time and time and time again. All right, we see this over and over and over again. So let me pull up the Trump coin just to show you like fulfilled versus unfulfilled gap. What do I mean by that? Fulfilled gap versus unfulfilled gap. This is on the 3-day for some reason. All right, so this is a fulfilled gap. As in, we'll make it very clear. When it first launched, you had your multiple parabolic rises. On the second parabolic rise, it smashed right through this area, which is fine. It's fine. However, it never came back, right? So when you have no gaps of trading, when there's just straight line up or straight line down, and there's no trading in that range, this is a gap. And these get filled, okay? Sooner or later, these get filled. MAGA has now filled this gap. A year later, right? So what do I mean by an unfilled gap? Well, here we go. It's the same thing. Like this big launch and you never backtest it. You never backtest it. Sooner or later, this is going to happen. Just the same. Sooner or later. $8 for FET. Are no rate cuts bullish or bearish? They're technically bullish. History would say, so it's been on both sides of history, depending on when you're looking at the markets. Crypto has only existed when a rate cut is actually bearish. Crypto has only existed during that time. But pre-2000s, rate cuts were bullish. Post-2000s, rate cuts have been bearish. So it's been on both sides of the equation. DOT or ICP, what are your thoughts? I would pick ICP from here. But I like DOT a lot. XEN, I would not be chasing green candles of a 20x. Absolutely not. XEN, I would be looking to de-risk and I would not be looking to add to that position. XEN is one of the first coins from 2022. When I say my 2025 price prediction is, XEN is one of my first coins that hit my 2022 videos macro bull market price prediction. That's my thoughts on it. What determines the two lines? There's nothing. You just look at prior. It's discretion is the so what determines it is you look at prior resistance and prior support. Prior resistance and prior support. If there is a point where resistance does not touch support, that would be what I would consider a gap. Example, if we look at Bitcoin throughout the bull runs, let's go on a cleaner chart. If we look at Bitcoin throughout the bull runs, let's put this on the weekly so we can see this. Okay? So here's the prior high, and what happens? You come down, bull market, bear market is on where? The prior high. So this gap is fully filled. So this is the same thing of why I'm saying in 2026, 2027, I think that we're going to come back to $60,000, $70,000 because that would be the healthy place to come back to. So what you look at is the difference between where the support is and where the structure is. Can you analyze the actual Trump coin? Yeah. Perhaps same thing. Like this is a huge launch. Where is the launch? Okay, so this would say, like you would say that this is on top of the actual launch point. I would say the launch candle, all of this is now on top of that. So technically, this would be a place where you could expect it to start accumulating. I would say that that's what this is. The beginning of accumulation. Selling climax. Automatic rally. Secondary test. Either this is the secondary test right here, or this is the secondary test in phase B. But I would call this phase A of accumulation. What am I talking about? I'm talking about Wyckoff accumulation, which is the schematic which measures the bottom. Selling climax. Selling climax. Automatic rally. Automatic rally. Your secondary test. So this is where it's like, now we need to use discretion. Is this the secondary test or is this the secondary test in phase B? We don't know. It's either here or here. So it's either at the beginning of phase B or it's at the end of phase A. But somewhere in this range is where Trump, the actual Trump coin is in my opinion. This is what is left. So it's just sideways. It's going to be sideways and boring. You might get a spring that takes you lower. It would be a flash crash. And then you're going to get your SOS and you're going to start working out of here. So if my thesis is correct and this is forming a bottom, what we would anticipate is some chopping, maybe a spring down to $21.50. Sign of strength, back test, mark up. The next leg for Trump would take you to $113. Maybe $160. It's not a great value here. It's all right. Let me see. What is the ROI for that? A 3x, 5x, 3 to 5x, maybe a 7x if you're lucky. So 220 is like the maximum. This looks to be forming a bottom though. 2 minutes. Does Wyckoff work on meme coins? Absolutely. What is Wyckoff? Wyckoff is supply and demand. Does meme coins have supply and demand? Wyckoff is supply and demand plus the psychology of investing. Do we have that? Do you have psychology? And do you have supply and demand on meme coins? Yes. Wyckoff works on everything. What is phase E? Phase E is the bull market, baby. Mark up. No, I would consider 2022 the recession. So 2020 was not really 2020 was the spring. Okay, what? We're going to keep an eye on this. I'm going to keep an eye on this. Okay, good. This is a good question. The 7-year cycle is technically 2029 is the next one. 2020 was not the 7-year. 2020 was the spring for the bull market. That was the bottom for Bitcoin. So even though 2022 they changed the definition as to what a recession is, by every definition pre-2021, 2022 was a economic recession. I know that they literally changed what that means. So problem solved. But by any definition pre-2021, a economic recession is 2 consecutive GDP quarters at a loss. Okay, so this was during 2022. So that was the start or the crashing or the bottom of the 7-year cycle. In addition to that, you had FTX went to zero, you had Luna went to zero, and you had the war in Ukraine. That kicked off. So that was all during 2022, which was the 7th year. If you would fast forward to project that out for the next 7th year, the next one would be 2029. But this right here, you're talking about COVID, was just the spring of the bull market. This was like the launch pad, literally, the launch of the bull market. So I understand what you're saying, but I disagree. Okay, here we go. Ah!
The past 2 years. Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong, is strong overall, and has made significant progress
Can you
toward
guys
our
hear this on
goals
TikTok?
over the past 2 years. Labor market conditions have cooled from their formerly overheated state and remain solid. Inflation has moved much closer to our 2% longer-run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. For 2024 as a whole, GDP looks to have risen above 2%, bolstered by resilient consumer spending. Investment in equipment and intangibles appears to have slowed in the fourth quarter, but was strong for the year overall. Following weakness in the middle of last year, activity in the housing sector seems to have stabilized. In the labor market, conditions remain solid. Payroll job gains averaged 170,000 per month over the past 3 months. Following earlier increases, the unemployment rate has stabilized since the middle of last year, and at 4.1% in December remains low.
JPZ.
Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.6% over the 12 months ending in December, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. Over the course of our 3 previous meetings, we lowered our policy rate by a full percentage point from its peak. That recalibration of our policy stance was appropriate in light of the progress on inflation and the rebalancing in the labor market. With our policy stance significantly less restrictive than it had been and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. As we previously announced, our 5-year review of our monetary policy framework is taking place this year. At this meeting, the committee began its discussions by reviewing the context and outcomes of our previous review that concluded in 2020, as well as the experiences of other central banks in conducting reviews. Our review will again include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. I would note that the committee's 2% longer run inflation goal will be retained and will not be a focus of the review. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer run inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Mr. Chairman, Steve Leisman from CNBC. Mr. Chairman, at a event in Davos, or to Davos anyway, the president said he'll demand that interest rates drop immediately. So I guess I have a 3-part question. Has the president done this to you? Has he made that demand? Secondly, what is your response to that? And third, what effect, if any, does a president making these kind of remarks have on policy? Thank you.
3 questions. I'm seeing it really as one question, though. So I'm not going to have any response or comment whatsoever on what the president said. It's not appropriate for me to do so. The public should be confident that we will continue to do our work as we always have, focusing on using our tools to achieve our goals and really keeping our heads down and doing our work, and that's how we best serve the public.
Can you just comment on whether he's physically communicated his demand to you?
I've had no contact. Thanks.
Nick Timmeros, The Wall Street Journal. Chair Powell, you and several of your colleagues said around the time of the last meeting that your policy stance was meaningfully restrictive. Given economic and financial market development since then, how has your confidence changed in an assessment that says interest rates are meaningfully restrictive?
I don't think that my assessment really has changed. I mean, a couple of things have happened. We've gotten more strong data, but we've also seen rates move up at the long end, which could represent a tightening in financial conditions. I think if we look back over the past year or so,
Great heavens.
we can see that policy is restrictive. If you look at the effect of high rates on interest-sensitive spending, for example, in housing, and if you look at the achievement of our goal variables, we're seeing the economy move toward 2% inflation and has moved largely to maximum employment. So we literally look at
My
movement of
God.
goal variables to make that assessment. Now, policy is meaningfully less restrictive than it was before we began to cut. It's 100 basis points less restrictive. And for that reason, we're going to be focusing on seeing real progress on inflation or alternatively some weakness in the labor market before we consider making adjustments.
If I could follow up, does the economy here warrant meaningfully restrictive interest rates? And would you judge interest rates to still be meaningfully restrictive if you were to lower them by another quarter point?
So I think our policy stance is very well calibrated, as I mentioned, to balance the achievement of our two goals. We want policy to be restrictive enough to continue to foster further progress toward a 2% inflation goal. At the same time, we don't need to see further weakening in the labor market to achieve that goal, and that's kind of what we've been getting. The labor market has really been broadly
it's the
stable.
limit.
The unemployment rate has been broadly stable now for 6 months. Conditions seem to be broadly in balance. And I'd say you look at the last couple of inflation readings and you see we don't overreact to two good readings or two bad readings, but nonetheless, the last couple of readings have suggested more positive readings. So I think policy is well positioned.
So at the start of the
Colby,
meeting,
New York Times.
we were at
How
101.4.
should we interpret the removal of the line from the statement that inflation has made progress towards the 2% goal? Is that no longer the case?
No. So let me look. If you just look at the first paragraph, we did a little bit of language cleanup there. We took out a reference to since earlier in the year as it related to the labor market, and we just chose to shorten that sentence. Again, if you look at the sort of intermeeting data, it was good, and there was another inflation reading, I guess, just before the December meeting. So we've got two good readings in a row that are consistent with 2% inflation. Again, we're not going to overinterpret two good or two bad readings, but this was not meant to send a signal. Other than this, you can take away from all of this that we remain committed to achieving our 2% inflation goal sustainably.
And just to follow up, we've seen inflation expectations across a number of measures rise sharply, which has in part been linked to tariff concerns. But there's also been this encouraging data that you mentioned in terms of CPI and rent indices. So how would you characterize concerns about upside risks to inflation across the committee, especially those tied to policies related to the Trump administration?
Well, I'd say you see expectations moving up a little bit at the short end, but not at the longer end, where it really matters. And those could be related to what you mentioned, some of the new policies. I think where the committee is very much in the mode of waiting to see what policies are enacted. We don't know what will happen with tariffs, with immigration, with fiscal policy, and with regulatory policy. We're only just beginning to see, actually are not really beginning to see much. And I think we need to let those policies be articulated before we can even begin to make a plausible assessment of what their implications for the economy will be. So we're going to be watching carefully, and as we always do. This is no different than any other set of policy changes at the beginning of an administration. We'll patiently watch and understand, and kind of not be in a hurry to get to a place of understanding what our policy response should be until we see how it plays out.
Michael McKee from Bloomberg Television and Radio. You and your colleagues normally condition future policy moves with the phrase, if the economy develops as we anticipate. Is it fair to say that since there's a lot unknown about what this administration's fiscal policies are actually going to be, that you don't have a medium to long-term economic forecast that you can have confidence in? Or if that's not true, can you lay out what you think is going to happen in the economy, how you see it developing?
Well, at all times, forecasts are conditional at a minimum on just a set of expectations, and they're highly uncertain in both directions. We know that economic forecasting is really difficult. beyond just a month or two out. So in the current situation, there's probably some elevated uncertainty because of significant policy shifts in those 4 areas that I mentioned: tariffs, immigration, fiscal policy, and regulatory policy. So there's probably some additional uncertainty, but that should be passing. We should go through that, and then we'll be back to the regular amount of uncertainty. So, what forecasters are doing, not just us, but everybody's doing, is they've got sort of just a set of assumptions about what might happen, but they're really kind of in the nature of a placeholder, and meaning, plausible could be, but honestly, you wouldn't stand behind it because you just don't know, and so you're just on hold waiting to see what comes down. It's a very large economy, and policy is affected at the margin, but we're going to wait and see.
If I can follow up, the idea that you feel that policy is restrictive suggests that the Fed in general wants to continue to lower interest rates. So when you look at the data that you are dependent on, are you looking for data that tell you that you can cut, or data that will tell you you should hold?
We're looking. It's more the other. The way it works is we are looking at the data to guide us in what we should do, and that's what we do. And right now, we feel like we're in a very good place. Policy's well positioned.
I look at those green
economy's
candles.
in quite a good place, actually, as well. And what we do expect is to see further progress on inflation. And, as I mentioned, as we see that, or if we were to see weakening in the labor market, that could foster, we could then be in a position of making further adjustments. But right now, we don't see that, and we see things as in a really good place for policy and for the economy. And so we feel like we don't need to be in a hurry to make any adjustments.
Howard Schneider with Reuters. Thank you very much. In 2021 at a central bank conference, you said, quote, throughout my career in both public and private sectors, I've seen that the best and most successful organizations are often the ones that have a strong and persistent commitment to diversity and inclusion. These organizations consistently attract the best talent by investing in and retaining a world-class workforce. First question is, do you still believe that? And if so, how do you intend to put that belief into practice while remaining consistent with the recent executive order prohibiting diversity and inclusion efforts?
So let me say yes, in answer to your first question. But to the second question, I want to say this. We are, like others, we're reviewing the orders and the associated details as they're made available. And as has been our practice over many administrations, we are working to align our policies with the executive orders as appropriate and consistent with applicable law. And I want to add that I'm not going to have anything more specific for you today on this whole set of issues.
Well, if I could just follow up quickly on that, I'm wondering how you're getting that to be consistent with the Dodd-Frank law's stipulations about maintaining an Office of Minority and Women's Inclusion.
So I did mention consistent with applicable law, right?
Which is governing.
Elizabeth. Thanks so much.
Fuck does that have to do with the Fed meeting?
Follow up on Steve's question. What reassurance can you give the American public that the Fed will continue to operate independent of politics under this administration?
As I've said countless times over the years, this is who we are. This is what we do. We study the data. We analyze how it will affect the outlook and the balance of risks, and we use our tools to try to, given our best understanding, our best thinking, try to achieve our goals. That's what we do. That's always what we do. Don't look for us to do anything else. And that's, lots of research shows that's the best way for a central bank to operate. That'll give us the best possible chance to achieve these goals for the benefit of the American people. That's always what we're going to do, and people should have confidence in that, as I said a few minutes ago.
You've said that the Fed is in wait-and-see mode based on the policies that come out of this administration.
I got you, humble
Has
servant.
the Fed started to model what policies like mass deportations, changes in immigration policy specifically, would look like for the workforce and for inflation?
So one of the things our staff does is they look at a range of possible outcomes, and they tend to go from really good to really bad, and it's one of the best things that they do. And in each teal book, you can look at the 5-year-old teal books and see They're alternative simulations. So that's what they do. It'll be a baseline, and then they'll show 6 or 7 alternative
Travis.
scenarios, including really good ones and not so good ones. And what those do is they spark, the policymakers to sort of think and understand about the uncertainties that surround this. So yes,
Decision's been made.
the
Nothing
staff
happened.
does that, and
No cuts, no
we're all
changes.
well aware that that the range of possibilities is always broad, not just now, but always. And it's hard to be open to just how broad the possibilities are for an economy. No one saw the pandemic coming, and it changed everything. So things happen, but yes, we do that. But it's different. It's one thing to do that, to make assessments about what might happen and begin to think about what you might do in that case, but you don't act until you see much more than we see now.
Katerina Saraiva, Bloomberg News. Last month you talked about a future rate cut as being pretty, significantly predicated on more progress in inflation. With the characterization of the labor market in the statement today, would you say that that's even more so the case now?
I'd say it's the same. We want to see, further progress on inflation. And, the story's there. We're just going to have to see the data. At the end of the day, it comes down to 12-month inflation, because that takes out the seasonality issues that may exist. And, we're just going to need to see that. We think we see the pathway for that to happen. One example, a key example, is that you now do see owner's equivalent rent and housing services, the way it's calculated for PCE. You see that coming down pretty steadily now, and that's the place where most of the remaining gap is. In addition, a big part of the overrun, as you will know, was from non-market services, which don't tend to send much signal. So you can look through all that and think, okay, then we seem to be set up for further progress. But being seemed to set up for it is one thing, having it is another. So we're going to want to see further progress on inflation. Remember, we're not, we're under 2%, but our goal is 2%, and we do mean to get back sustainably to 2%.
And in terms of the labor market, I mean, how is that broadly, you said a broad set of indicators show that it's in pretty solid place. Was there broad agreement on that? There's been a few underlying indicators that are showing perhaps some weakness, a low hiring rate, workers reporting that it's increasingly difficult to find a job. Is that of concern to the committee?
So you're right. I mean, we look at, of course, a very broad range. So it starts with unemployment, with the unemployment rate, employment participation, wages, job quits, are people quitting, that kind of thing, the ratio of vacancies to unemployed. We look at all those things, and you put your finger, though, on it's a low hiring environment. So if you have a job, it's all good. But if you have to find a job, the job finding rate, the hiring rates have come down, and that's more typical of a. Let's say that the unemployment, that the labor market is at a sustainable level. It's not overheated anymore. We don't think we need it to cool off anymore. We do watch it extremely carefully. It's one of our 2 goal variables. But I'd say we watch those things quite carefully. But nonetheless, overall, look at the aggregate data in the labor market. The labor market does seem to be pretty stable and broadly in balance when you've got an unemployment rate that has been pretty stable now for a full half year.
Thank you. Thank you, Mr. Chairman. Edward Lawrence with Fox Business. On employment, now you said there's a broad range of possibilities, but last September you said, quote, "We understand that there's been quite an influx across the borders, and that has actually been one of the things that's allowed unemployment rate to rise." Now that the flow of the border has slowed and we're seeing deportations, how do you expect the unemployment rate to react?
What's happening is that the flows across the border have decreased very significantly, and there's
My
every
thoughts have
reason to
not
expect that to
changed.
continue.
I'll do an
And
analysis
so,
after you finish
but job
talking.
creation has come down a bit too. So, if those 2 things come down together, that sort of can be a reason for the unemployment rate to stabilize. In other words, the break-even rate, as population growth slows, the break-even rate that you need in new jobs to make jobs for workers declines as well. So that seems to be something about what's happening. You do see a very flat unemployment rate at a time when you've seen significant declines.
I want to ask you about Fed employment. I know that tax money is not used here, but Elon Musk alleges that the Fed is, quote, absurdly overstaffed. We've seen the executive branch push to reduce the federal workforce. I just want to get your reaction.
You know, we run a very careful budget process. We're fully aware that we owe that to the public, and we believe we do that. And I've got no further comment than that. Thanks.
Chris Rugaber at Associated Press. President Trump has said he will lower inflation by reducing gas and energy costs. Do you see such costs as a particular driver of inflation, and would lowering them have a dramatic effect?
Chris, I'm not going to react or discuss anything that any elected politician might say. So I'll give you a mulligan.
Okay, thank you. Well,
I don't understand.
Nearly 2 weeks ago, the Fed said it was withdrawing from the network for greening the financial system, even as we have significant wildfires in Los Angeles doing billions of dollars in damage. And of course, the NGFS, as you know, is a group to talk about how the financial system could address climate change. Many commentators did see the timing as political. Why did you leave that organization? Can you explain that decision? Sure,
I'd be glad to. So we considered this, really at length, and we did decide to withdraw from the NGFS. And really the reason is that the work that the NGFS does has broadened very significantly. Think about nature-related risks and biodiversity and things like that. In addition, the work of the NGFS is in significant part intended to, and this is a quote, mobilize mainstream finance to support the transition toward a sustainable economy. So we joined to get the benefit of understanding what other central banks were doing and seeing research and things like that. I think this is just way beyond any plausible mandate that you could attribute to the Fed. And so we have a quite narrow role, as I've said many times, and I think that the activities of the NGFS are not a good fit for the Fed, given our current mandate and authority. So, and I just think it was time to acknowledge that. This process dates back, thinking about it dates back a couple of years. I made the decision to bring this to the board, some months ago. The process just took time to get here, and this is when we got it and voted on it. So, and I'm aware of how it can look, but it was really not driven by politics. It was driven by kind of the disconnect between the work of the NGFS and our mandate. Other central banks have different mandates and belong to the NGFS. We have no criticism of them, but it just isn't, it's not right for the Fed.
Andrew.
Thanks. Andrew Ackerman with the Washington Post. I'm wondering if you could talk more about what further progress would look like for consumers.
Well, 2% inflation down to 2% sustainably is what we're trying to achieve. We're somewhat above that, as you know, and we want to see serial readings that suggest that we're making further progress on inflation. That's what we want to see, and consumers will pick that up, of course, in the things that they buy at the grocery store or at the store.
The other thing I wanted to ask was just how far away you think you are from neutral.
Yeah, you can't know with any precision, of course, as I like to say, that you know the neutral rate by its works. So I think at 4.3%, we're above pretty much everyone on the committee's estimates of the longer run neutral. I think our eyes are telling us that our policy is having the effects on the economy. That's really the question we ask. You can consult models, empirical models, theoretical models. You really have to just look out the window and see how your policy rate is affecting the economy. And I think we see that it's having meaningful effects in bringing inflation under control. It has helped bring the labor market into balance as well. So that's what we think. I would say we're meaningfully above it. I have no illusion that anyone knows precisely how much that is. But not knowing that and having cut 100 basis points means that it's appropriate that we not be in a hurry to make further adjustments.
Victoria.
Adam says they need to talk to us like we do.
Victoria Guido with Politico. So, as a general matter, when it comes to executive orders and OMB memos, do those always apply to the Fed? Sometimes, never, or do you just often voluntarily comply? What is the legality there?
So it's been our practice, as I mentioned, to work to align our policies to those that are mentioned in the executive orders, and I'm just going to leave it at that. As I mentioned, I'm not going to go any deeper than that or get into any deeper into this set of issues today.
Claire Jones from the Financial Times. Two questions, if I may, on tariffs. Well, first of all, we've seen global trade wars before, notably in 2019, last time around, but then we were in a very different place on both inflation and growth. If we see tariffs of the same sort of magnitude that we got then, which I know is big if, what do you think might be different this time around? And secondly, Tiff Macklem said there was no doubt that the threat of tariffs was a big driver of the cut by the Bank of Canada today. What sort of information would the Fed need to see on tariffs before it was willing to take such a preemptive move? Thank you.
Sorry.
What sort of information would you need to see on tariffs? Would you need to see a strategy, actual implementation, actual movement of inflation expectations before you're actually willing to change the path of monetary policy on the basis of it?
Yeah, so first of all, things are a little different now. We've just come through a high inflation period, and you can argue that both ways. You can say that companies have figured out that they do like to raise prices, but we also hear a lot from companies these days that consumers have really had it with price increases, and so I don't know how that shakes out. Nonetheless, you're coming through a situation where we're not quite back to 2%, and that's just different. In addition, the kind of footprint of trade has changed a lot as trade is now spread around. It's not as concentrated in China as it was. There's a lot more manufacturing. It moved to Mexico and other places. So there are differences, and I just think the range of possibilities is very, very wide. We just don't know, and I don't want to start speculating, as tempting as it is,
Please,
because we really don't know, and we didn't know, by the way, in 2018. We didn't really know, and the range of possibilities very, very wide. We don't know what's going to be tariffed. We don't know for how long or how much, what countries. We don't know about retaliation. We don't know how it's going to transmit through the economy to consumers. That really does remain to be seen. There are lots of places where that price increase from the tariff can show up between the manufacturer and the consumer.
Rumor has it he's going to
just so many variables. So we're just going to have to wait and see. And the best we can do is what we've done, which is study up on this and look at historical experience, read the literature, and think about the factors that might matter. And then we'll just have to see how it goes.
Thank you. Courtney Brown from Axios. Two unrelated questions. The first is whether or not there was any discussion about QT and the timeline for ending QT at this meeting. And then the second question is just, I wonder if the AI-prompted sell-off in the stock market this week signaled anything to you about the state of financial conditions?
So let's talk about runoff. So the most recent data do suggest that reserves are still abundant. Reserves remain roughly as high as they were when runoff began, and the federal funds rate has been very steady within the target range. We track a bunch of metrics, and they do tend to point to reserves being abundant. We do intend to reduce the size of our balance sheet to a level that's consistent with implementing monetary policy efficiently and effectively in our ample reserves regime. We're closely monitoring a range of indicators to assess conditions, and that should provide signals whether reserves are approaching a level that could be judged as, quote, somewhat above ample. I don't have anything to say to you about particular dates. It's just that's the process, and what we see is that rates do appear to be abundant. as always, we stand ready to take appropriate action to support that smooth transition of monetary policy, including to adjust the details of our approach for reducing the size of the balance sheet in light of economic and financial developments. On AI, it's a big event in the stock market and in particular parts of the stock market. I mean, what really matters for us is macro developments, and that means substantial changes in financial conditions that are persistent for a period of time. So I wouldn't put that label on these events, although, of course, we're all watching it with interest.
Simon Rabinovich with The Economist. Thank you. You mentioned in your remarks that activity in the housing sector seems to have stabilized. At the same time, since your first rate cut in September, long-term mortgage rates have gone up by a full percentage point, back above 7%. I'm wondering, kind of looking forward, are you confident that activity will remain stable given how elevated mortgage rates are? How does it fit into your broader thinking about the economy?
So, as you know, as we've reduced our policy rate 100 basis points, longer rates have gone up, not because of expectations, not principally because of expectations about our policy or about inflation. It's more a term premium story. So, and you know, it's long rates that matter for housing. So, I don't think I think these higher rates are going to they're probably hold back housing activity to some extent if they're persistent. We'll have to see how long they persist. So. You know, we control an overnight rate. Generally, it propagates through the whole family of asset prices, including interest rates. But in this particular case, it's all happened at a time when, for reasons unrelated to our policy, longer rates have moved up.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you want to see further progress on inflation. Given that households appear to be unhappy with the elevated level of prices, do you believe the committee should wait until inflation has fallen back to target to cut rates again?
No, I wouldn't say that. We've never said we need to be all the way at target to reduce rates. At any time, what we're doing is we're looking at the economy and asking whether our policy stance is the right one to achieve maximum employment and price stability. So I think if we would want to see further progress. But we think our, as I mentioned, we think that our policy stance is restrictive, meaningfully restrictive, not highly restrictive, but meaningfully restrictive. And so I would think we need to see further progress. I wouldn't say all the way back down to 2% on a sustainable basis, although we'd love to see that, of course, and we will.
And separate question for you on tariffs. Curious whether the threat of tariffs and not knowing whether they could stick or not creates uncertainty for business here in the United States and could cause them to pull back, ultimately weighing on growth. Does the threat of tariffs cause you to ponder your growth forecast?
You know, I want to avoid commenting even indirectly on the conduct of tariffs. You know, it's not our job, and it's not our job to comment on the moves that people make. So I wouldn't want to criticize anything that's happening or really comment on it one way or another, praise it for that matter. It's just not our job. I do think that, you know, we found in 2018 there was a lot of work done on trade policy uncertainty. Trade policy uncertainty, if it's large and persistent, can start to matter for businesses making investment decisions and things like that. That's not something I'm observing today. It's very early days for this, but that did. I think that did matter in 2018-19, and it's one of many things we'll be watching.
Matt.
Thank you, Chair Powell. Matt Egan from CNN. Following up on Courtney's question from earlier about the stock market, how concerned are you, if at all, about potential asset bubble brewing in financial markets? How do relatively high market valuations factor into considerations about potentially lowering interest rates further? Is that something that's in the back of your mind?
So we look at, from a financial stability perspective, at asset prices generally, along with things like leverage in the household sector, leverage in the banking system, funding risk for banks and things like that. But it's just one of the four things asset prices are. And yeah, I'd say they're elevated by many metrics right now. A good part of that, of course, is this thing around tech and AI. But we look at that. But we look at how resilient the households and businesses and the financial sector are to those things. So we look at that mainly from a financial stability perspective, and we think that there's a lot of resilience out there. Banks have high capital, and households are actually overall, not all households, but in the aggregate, households are in pretty good shape financially these days. So that's how we think about that. We look at overall financial conditions, and you can't just take.
Thanks for the hat mustache.
You can't just take equity prices. You've got to look at rates too, and that represents a tightening in conditions with higher rates. So overall, financial conditions are probably still somewhat accommodative, but it's a mixed bag.
Hi, Chair Powell. I'm Richard Escobedo with CBS News.
He said 28.
One question for you. This month's statement notes that unemployment is stabilized at a low rate and that the labor market is solid. You walked through some of what's driving this, but I wonder what risks you see that might challenge your assessment.
Well, the things we discussed earlier. One is that there's a low hiring rate.
So
that if there were to be a spike in layoffs, if companies were to start to reduce headcount, you would see unemployment go up pretty quickly because the hiring rate is quite low. So that's one thing we look at. I think it's worth pointing out that for lower income households, they're under significant pressure, and in the aggregate, the numbers are good, but we know that people at the lower end of the income spectrum are struggling with costs, and really it's high inflation for the basics of life. It's not so much the inflation now; it's the price level, because inflation has raised prices. Inflation is now much closer to target, but people are really feeling that. But overall, this is a good labor market. You're at 4.1% unemployment. That's just a really good level, and you've been solidly there now for 6-7 months. And job creation is pretty close to a level that will hold the unemployment rate there, given that there'll be much lower population growth.
One more question. Some of the uncertainty around immigration policy, in your assessment, is that making it harder for businesses and the Fed to plan going forward?
We hear anecdotal reports, but I don't see. There's nothing in the data yet on that. But you hear that kind of thing about construction, for example, and businesses that are dependent on immigrant labor are saying that it's suddenly gotten harder to get people. But you don't see that in the aggregate data yet. But yes, you hear it anecdotally.
Thank you, Chair Powell. Nicholas Jasinski from Barron's. The uncertainty is certainly a theme today, and I'm wondering, are there any periods from your career, or as it relates to markets, the economy, what's going on here in Washington and beyond, or from lessons from history that may provide some guidance for a central banker operating in uncertain times like today?
I guess I'd say this. Uncertainty is with us all the time. It is human nature, apparently, to underestimate how fat the tails are in a way. The possibility, we think of things in a normal distribution, and in the economy, it's not a normal distribution. The tails are very fat, meaning things can happen way out of your expectations. It's never not that way. I wouldn't, if you think about it, think about the first few months of the pandemic. That was uncertainty. Are we going to be able to reopen the economy? If so, when? How much of it? How long will it take? That was uncertainty. What we have now is a good labor market. We have the economy growing at 2 to 2.5%. Inflation's come down to now the headline inflation number was 2.6, and that's what the public experiences. We look at core because it's a better indicator of future inflation. So yes, the price level went up a lot
Some
for
of the
inflation.
reporters
People
are
are feeling
sorry.
that, and they're not wrong. But so the kind of uncertainty we have is just a usual level of uncertainty about the economy, but then policies which are not for us to criticize or praise, really. Those are policies which people have been elected to implement. They're implementing them with a view to making a better economy. And so I wouldn't call this out as one of those times. I wouldn't compare it to the global financial crisis or anything like that, given that we have actually a very good economy right now.
Evan Reiser with Market News International. Chair Powell, is a March cut still on the table? And then additionally, are you looking to see better than expected data on inflation to cut? Or are you looking for inflation data that roughly aligns with current forecasts?
So as I mentioned, the economy's strong, the labor market's solid, downside risks to the labor market appear to have abated, and we think disinflation continues on a slow and sometimes bumpy path. That tells me, and the other members of the committee, the broad sense of the committee actually is that we don't need to be in a hurry to adjust our policy stance. Your second question was?
Whether or not you need to see better than expected inflation data or just inflation data that roughly aligns with your current forecasts?
You know, it's one of those things, we'll know it when we see it, but more the expectation is that we will make continued progress. And, you know, that's what we want. We'll know it when we see it. It's going to have to be something that isn't just idiosyncratic. You're going to want to see, you know, continued progress with housing services inflation. You're going to want to see inflation behaving in a way that builds confidence that we are really making progress. That's what it's going to be. And I mean, is that better than our expectations? We expect to see that. It's just a question of when.
Hi, Chair Powell. Scott Horsley from NPR. In your 5-year review, you said the 2% inflation target won't be on the table. Can you talk a little bit about why? Is that because you think that's the right target, or is it because you don't want to move the goalpost mid-game, or what's behind that?
I think that goal has served us well over a long period of time. It's also the sort of global standard.
He picks up satellite with them things where you can set fire.
If a central bank wanted to look at changing that, you wouldn't do it at a time when you're not meeting it anyway. I would not look at changing it anyway, but I certainly wouldn't look at it at a time when you're not meeting it. I mean, there's just no interest at all.
Well,
in
we're watching
if
Fed.
I'm being at all unclear. We're not going to change the inflation goal anytime soon.
And 5 years ago, if I can paraphrase what y'all decided, it was you're going to not raise interest rates preemptively to head off inflation until you see sort of the whites of the eyes of inflation, because the solid labor market was so beneficial. Have the last few years changed your thinking about that?
So what we really said was that we wouldn't look at a strong labor market and raise rates unless we saw some evidence of inflation. So the thought was that we'd seen really low levels of of unemployment with no sign of inflation. So why would you preemptively want to put people out of work in the absence of any kind of any evidence that suggested that this was not a sustainable level? It was a way of acknowledging how much humility we have about the starred variables, especially U-star, the natural rate of unemployment. So that was that was an insight. We'll discuss that again. That'll be one of the many things that we discuss. But I don't think that insight is wrong. We didn't, you know, we said what we said was that, you know, at times when inflation persistently undershot 2%, we would likely allow inflation to run moderately above 2% for some time. That's what we said. That turned out not to be relevant to what actually happened. There was nothing moderate about the overshoot. It was an exogenous event. It was the pandemic, and it happened. And you know, our framework permitted us to act quite vigorously, and we did once we decided that that's what we should do. The framework had really nothing to do with the decision to. We looked at the inflation as transitory, and right up to the point where the data turned against that. And when the data turned against that in late 21, we changed our view and we raised rates a lot. And here we are at 4.1% unemployment and inflation way down. But the framework was more irrelevant than anything else. That part of it was irrelevant. The rest of the framework worked just fine as we used it, as it supported what we did to bring inflation down.
Let's go to Mark for the last question.
Hello, Chairman Powell. Mark Hamrick with Bankrate. As you know, in the annual report from the Financial Stability Oversight Council, among the risks outlined is cryptocurrency. Could you talk about those risks now? And regarding individuals and households, perhaps distinct from the concern about the financial system, do you worry that speculation in this unregulated asset class could hurt their financial well-being, or do you think it has a place in a household's portfolio?
You know, so our role with Bitcoin really is to look at, with crypto, really is to look at the banks, and you know, we think it's.
Was this on your
you
bingo
know,
card that
banks
he was
are
going to
perfectly
talk about Bitcoin and
able
crypto?
to serve crypto customers as long as they understand and can manage the risks, and it's safe and sound. As a good number of our banks that we regulate and supervise do that. You know, the threshold has been a little higher for banks engaging in crypto activities, and that's because they're so new, and you don't want to make the mistake. If you're making a choice to conduct that activity inside a bank, which is inside the federal safety net with deposit insurance, then you want to be pretty sure that it's a safe and sound activity. So, you know, we're not against innovation, and we certainly don't want to take actions that would cause banks to, you know, to terminate customers who are perfectly legal just because of excess risk aversion, maybe related to regulation and supervision. So.
And with respect to households and their inclusion in that asset class?
You know, that's kind of it's not really our bailiwick. You want people to be knowledgeable about the financial engagements that they have, and that's why we have, you know, the securities law.
Thank you for the
laws that we have.
boxing.
It's why, you know, if you read a mutual fund prospectus.
All right, was
or,
it on your buzzer that he was
individual
going
stock
to be
prospectus,
bullish for
you
crypto
want
and say
households
that
to
it
have
was
the
cool?
chance to
Was that
understand
on
the
your
risk
bingo
that they're
card?
taking, and you know, I do think it would be helpful if there were a greater regulatory apparatus around crypto, and I think that's something Congress was working on quite a lot. We've actually spent a lot of time, you know, with members of Congress working together with them on various things, and I think that would be a very constructive thing for Congress to do. Thank you.
Wow. I did not predict he was going to say that. I think that tells you everything that you need to know. I think that tells you everything you need to know. They keep telling me it is different this time. But ski, my wife's boyfriend told me that Bitcoin's going to 12K. What should I do? It's different this time. Ski! But ski, my wife's boyfriend told me that Bitcoin's going to 12K. What should I do? Thank you for the fear, the love, the boxing, you savages. Thank you for all the gifts. Let's turn the music back on. And let's recap what just happened. Let's recap what just happened. So basically, he was very dovish. Anticipated a little bit of volatility, but that was a bombshell at the end there. I did not have that on my bingo card. Him addressing Bitcoin, addressing crypto, and addressing the fact that he has absolutely no plans to stop innovation in the cryptocurrency market cap. That is a big deal. He just said that crypto is here to stay. Exactly. Travis, thank you for the galaxy. Joey, thank you for the heart. Kevin, thank you for the rose or the heart. Nick, thank you for the W, the chili, the lightning, the tiny. You savages.
But the cream will rise to the top. Oh, yeah.
All right, if anyone was confused, I keep telling you, it is not different. Not different at all. All right? $118,000 is the next leg up. I'm gonna end with this, and then I'm gonna do a daily market news and analysis video, and then I'm gonna do Crow, Quant, Flux, and ICP. I'm gonna do individual videos on those. If you guys want individual videos, comment them in my videos. So, here is my analysis. That was a bombshell at the end. I did not have that on my bingo card. But what do I keep saying? Show me the charts, and I will tell you the news. $118,000 is the next leg higher. $118,000 is the next leg higher. That is what we need. That is what's going to happen very soon. This was a normal dead cat bounce to the 618, double bottom, breakout, Back test of the prior range. Bullish. Get the gaps out of the way. Rip the Band-Aid off of. That is what just happened. By the end of February, I think that Bitcoin will be above $118,000. Check it out. There is no more uncertainty for the next 2 months. And he literally at the buzzer, bang, bulls win, bulls win. At the buzzer, what happened? Bullish news on crypto. Show me the charts and I will tell you the news. Come on now. You can't make this stuff up. 118,000 by the end of February. I've said it for a month. 118,000 by the end of February. Say it with me. 118,000 by the end of the February. And that will start the alt season. Everyone keeps saying it's canceled. Meanwhile, Jay Peasy just left off with like, we're not stopping innovation for crypto. It should be in your portfolio. It's good for banks to do that. At the buzzer. Come on now. Show me the charts. I will tell you the news. Come on now. 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 All right, guys. I'll be live later tonight. Make sure you guys, maybe not. This is the second live, all right. Make sure you guys follow, subscribe, follow me on YouTube, Instagram, Twitter, Twitch. I will be uploading the daily market news analysis right after this, and then I'm going to do a couple of reviews on different coins. I'm live every single day. If anyone had any doubt, if ye among you who had ye of little faith, who had any doubt, there we go. All right, guys. Peace, love, prosperity. God first. God bless.